Hi, I'm Scott Rickel, Hegg Realtors. Welcome back to the Hegg blog. This week I'm taking another look at calculating market value of your house. The question we get asked a lot when we go to list a property is the seller will give us the amount that they paid for the house, say $100,000, and they tell us, that's what I paid for it, so I have to get more than that, otherwise I can't move. Well, of course, we all want to make money on it, but I think we have to take a step back and look at real estate just as you would any other investment like the stock market. Now, the question is, does the initial investment, plus or minus your improvements, is that an indicator of its current value? Not always necessarily. If you look at the stock market, if you had bought shares of Apple when it first came out, they were $3.83 a share. Now it's $395 a share. So okay, it's 100 times its value from the early 1980s. If you had bought Enron at its peak when it was $90, well, you just pretty much don't have that money anymore. So likewise, there are ups and downs with the real estate market. Market value is subject to a lot of different things, but what you put into it isn't necessarily one of them. Take an example. If we have three completely identical houses, for sake of argument, 1, 2, 3. First person bought their house for $100,000. Second person was able to negotiate a little bit more, maybe the seller was in a weaker position, and they bought the identical house for $90,000. Third person inherited the house. They have no investment in it. So is this house worth 0? This worth 90? This worth 100? No, they all have a relative market value. The only real variables to think about here, if you had three hypothetically identical houses, would be plus or minus the improvements or the depreciation that occurred in the house. If this person took good care of theirs, this one added a new kitchen, and so on and so on. Those things would be some good indicators of how it would change their market value. However, if everything stayed static and all three houses remained the same, all three would have, in theory, the identical market value. Just whatever the market had done recently, if it had gone up or down. Like right now, we're a little bit down. Some of our prices are going back as far as 3, 4, 5 years ago in certain price ranges. So this $100,000 house might be worth 95 right now. Likewise, all the rest of them. So and likewise, if they had gone up, well, he stands to make more or less of a profit than what this person would make, or this one, obviously. So does the initial investment plus or minus improvement, it's absolutely equal value? No, not necessarily. These are big variables in here. Just because you paid something for a house does not make it necessarily worth that. Perhaps you overpaid for it in the first place. So that can affect things too. So keep that in mind when you're looking at a house value, that treat it kind of like the stock market. You're not always guaranteed a profit. There's a lot of variables that go into it, but market value will determine what it's worth, not necessarily what you put into it. Thanks for listening.